So thank you very much for the invitation to talk here. It's an honor to be here with such renowned names. My presentation is after Matheus and before John Smithing. So, okay, I hope I can contribute with something. Yeah, so since my undergrad, I'm interested in this topic, broadly the political economy of monetary policy, who wins, who loses with monetary policies. And I think it's very related to the discussion we are having here. And in my PhD, I continued developing a framework, a modeling framework that we had in the Federal University of Rio de Janeiro. It's a very extensive model, very complex. And my personal opinion is that it's a powerful framework that can be used for several different topics, right? Different policies, micro level, macro level. And so I decided to use this framework to try to discuss a little bit the topic of monetary policy and income distribution. So my motivation is, of course, we all know that since before the financial crisis, we all agree with that, but the financial crisis kind of forced a little bit more the rethinking on the new consensus ideas, especially on the theory behind it, the models, the way we model the methodology, and of course, the policy recommendations. So if we continue to use the traditional Taylor rule, a single mandate, I put it single-minded, but yeah, single mandate monetary policy, we can have some adverse effects. And we can only, since, as for instance, the well-known price puzzle or Gibson's paradox, right? And of course, the effects of monetary policy on income distribution. So, but we can only see these effects if we get rid of the bounds of the traditional transmission mechanism. So I started to research, read more on the transmission mechanisms. And if we go to the traditional ones, the conventional ones, we have 5 or 6 transmission channels, right? But the point is, all of them, regardless of the strength or the timing, all of them will have a negative effect of the basic interest rate on demand. And there is also this final link from demand to prices. So regardless of which transmission mechanism is the strongest one, the effect of monetary policy will always be the same. We will always be able to control inflation, right? Changing the basic interest rate. But let's try to see some what I call heterodox transmission mechanisms. So for instance, yes, we have the exchange rate effect here, but it's basically through exports, right? And then it affects demand and then prices. But the exchange rate, as Lillian pointed out in her presentation yesterday, can have some effects on the cost structure. So basically what I'm trying to see here is, let's accept all the traditional mechanisms, but let's just question this final link here. Let's just question the link from demand to prices. Let's assume a more oligopolistic structure. Let's say that firms set prices based on costs. So we can have an effect from the basic interest rate through the cost structure. So the cost of imported inputs or the cost of the price of the external competitors, right? We can have an interest rate cost. Well, let's say financial interest payment is a financial cost for the firms, right? If they consider that as a cost in their cost structure, and they set prices based on the cost structure, this will eventually affect prices. And this is one of the channels that might explain the price puzzle, right? And we have, of course, a distributive channel. Let's say the basic changes in basic interest rate will give more income to surplus agents and less income to deficit agents. And let's say these agents here have a lower propensity to consume. The average propensity to consume will fall, and this will reduce demand. Not say that this will affect prices, but there is this effect, might have this effect on demand, right? And finally, when I was trying to understand all these mechanisms, now if we accept these other channels, they might have ambiguous effect. You can have one channel that reduces demand, one channel that increases demand. So we need to consider the complexity around all these channels, right? And in addition, we need to consider microeconomic effects. We are basically discussing micro price setting, right? So we need to understand the competition structure in different markets. So we need to consider this sectoral and micro effects in an integrated way. So these are more methodological critique, and that's what led me to decide to use this model, which is we have several denominations. It's agent-based, it's stock and flow consistent, it's a multisectoral model, it's a demand-led growth model. You can think as a structuralist model too. It's rooted in several unconventional theoretical foundations. So we have Keynesian elements, several Calexian elements. We have Schumpeterian elements in the technological change, how firms innovate, imitate on product and product innovation and process innovation, right? And I introduced some Minskian elements to the model too, to the financial side. As I said, it's a multisectoral model. We can have several sectors in our input. It's an input-output model. So we have these intersectoral relationships. It's a dynamic model. It's not an equilibrium model. So we get rid of the concept of equilibrium. We have dynamic trajectories, right? And we need to simulate to see these trajectories in time. It has path dependency. So it's micro and macro. So the decisions happen in the firm level, but they have consequences on the sector and the macro with feedback mechanisms. It's a theoretical model. You can argue that you can calibrate some parameters to approximate to a specific economy, but I would say it's a much more theoretical model, right? It's agent-based. We have the firms interacting and having decisions, and it's also consistent on the stock and flow side. So that's the structure of the model. It's a little bit complex, but we have at least 3 productive sectors with firms in each sector. We can have more than 3. We can have several capital good sectors, several consumption goods. I use the minimal structure possible that is already complex enough. All firms produce, they need intermediate goods. Even the intermediate good firms, they need inputs to produce. Of course, they demand labor, so they pay wages to, we have an income class structure. And of course, they have investment decisions. They buy capital goods from the capital goods firm. All firms eventually will sell their products, will have profits. They will distribute a share of their profits to the income classes. They will pay wages and R&D expenses. We consider R&D expenses as a sort of wage. We have a government that pays government wages and unemployment benefits to this class and collect taxes, income taxes, and taxes from the firms. We have an external sector, so it's an open economy. It interacts with all the other sectors. So we have this simplifying, the simple external sector that demands goods from all the productive sectors. And we have a financial sector composed by several banks that provide loans to the firms and to the income classes. So it's possible that some income classes consume more than the income, so they demand some loans from the financial sector, and the banks eventually have profits and distribute part of their profits to the income classes, right? So these income classes is, we use 3, but we can have several income classes. And we have a matrix of income appropriation, right, a la Miyazawa. So basically we have 3 sources of income: wages, industrial profits, and let's say financial profits. And we can have any combination of a matrix. So if we have 3 classes, we have a 3x3 matrix. And to simplify in this version, I use an identity matrix. So we have 1 class receiving all the wages, 1 class receiving all the industrial profits, and 1 class receiving all the financial profit. But this can be generalized, right? You can have, and they are basically different on their propensity to consume, on their past income, okay? There is one source of autonomous consumption that is related to the product innovation of the consumption good firms. right? So not all the consumption is induced. So let me try to show what is, I have 30 minutes. I don't know when I started. Understand, okay. I think I can do it. So let me show some equations. So each firm will set that price as a weighted average of the desired price and what I call the reference price. Okay, this kind of captures the degree of monopoly, Kaleckian degree of monopoly. The reference price is a weighted average of the sectoral average price and the external price. So let's say they have external competitors, and they will weight this by the proportion of exports over the total orders of the sector. So if you have one sector that exports a lot, of course, they will consider more the price of their external competitors as their reference price. Their desired price is a simple markup equation. It's desired markup over the unit variable cost. Okay, let me skip this. The unit variable cost is the wage unit cost, right? The wage rate divided by the average labor productivity is average here because the firms have different vintages of capital goods. Each capital good have a different labor productivity. So we consider the average of all capital goods of the firm. We have the intermediate cost, so the cost of inputs there. And I added here to try to capture one of the channels we discussed, the financial cost here. So let's say the firms introduce some measure of unit financial cost here to their variable cost. This parameter here is the sensitivity, or how the pass-through, how much they will pass the financial costs to prices, right? This will be the target of our simulations in the end. And this is the unit financial cost, is the sum of interest payment divided by the desired productive capacity, okay? Right, and finally, the desired markup, it grows if the market share of the firm is greater than the desired market share, and it grows based on the growth rate of the market share. So basically, if the firm is gaining market share, it has ability to increase that desired markup. It doesn't necessarily will increase the effective markup, because remember the price equation is a weighted average, right? So, and the wage rate, it increases based on past inflation and past productivity growth. Again, we have these two pass-through parameters. They are not equal to 1. In fact, in our baseline, I set them to 0.5 each, okay? And again, we will explore these parameters. This kind of captures the bargaining power of workers, how much they gain more wage based on past inflation and productivity, okay? Right, so let's discuss a little bit the interest rate structure. We have a simple Taylor rule equation here for the central bank interest rate. We have, if the inflation is on target, the central bank interest rate will be this value here, which is the nominal interest rate. The central bank is not natural, it's just arbitrary, is a decision variable set by the central bank. And this, again, this is what we will explore. We will change this parameter, change the level of interest rates to see the effect on the model. Okay, but this is just the central bank interest rate. Each bank has a base interest rate that is a spread over the central bank, right? But again, similar to the price equation, is a weighted average, right? So it's a desired spread and weighted by the average spread of the financial system, okay? This is not very strong, this effect here, because the empirical evidence shows that banks do not compete as much as in the interest rate, right? But we can have some sort of competition dynamics in the financial sector here to affect the interest rate structure. But this is the bank interest rate. However, each bank has specific clients, specific firms, and they will apply like a risk premium to each specific firm. So the interest rate the firm will pay is the bank interest rate plus a risk premium depending on the firm-specific debt rate. If the firm is highly indebted, the bank will apply a higher spread to. So this will be the interest rate the firm will pay on the loan, right, when they need to finance their investment decisions. And this will affect the financial cost of the firm. This is basically the interest rate they will pay on their loans. Okay, so this is the firm profits. Let's talk a little bit about income. The net profits of the firm is the revenue discounted the tax rate. This is a parameter, is a share of the revenue that they pay as R&D expenses. We have the unit wage cost, the unit input cost, and the net financial gain. So interest on deposit minus the interest payment on loans. Okay. This is the net profits of firm. Doesn't mean that this will go to the income classes, right? They distribute a share of the total net profits and retain a percentage to have some sort of internal funds to finance some investment decisions. So what will go to the income class is not the entirety of this, it's a share. Similar to bank profits, so the banks will receive the interest on their loans. They hold the government bonds, so the interest the government pays on their bonds goes to the banks, and this will affect their profits, minus what they pay on their deposits and the default loans, right? If some firms go bankrupt, they don't repay their loans, this will reduce bank profits. Again, banks will keep a share of their profits as regulatory buffer, right? And will distribute the other share to the income classes. So total distribute industrial profits is just the sum of the distributed profits of all the firms, the same for banks. And this is total wages, the wage of all firms plus a government wage. It goes to one of the income classes. So this is the disposable income of each income classes. This is the parameters that I mentioned on the appropriation matrix, right? So for each class H, we have these three parameters that of course, they need to sum up one, right? For all the wage, industrial profits and financial profits. And I'm simplifying, so I'm saying, for instance, class 1 will have 0 appropriation of wages, 0 appropriation of industrial profits, and 100% of financial profits, right? So like the rentiers, the financial capitalists, if you want to call. Class B or second class will be the industrial capitalists, and the class C will be the workers. Okay, so the model is written on LSD. It's available, it's freely available on my GitHub if you want to look at the code, the equations. The advantage of this model is that we can run several simulations, right? We can run several trajectories for the same condition. The model has some sort of stochastic elements that will generate different trajectories, but we can run independent simulations for the same conditions. The baseline, we'll call the baseline here, or show the baseline results. And we can analyze on the short run, on the long run. We run 600 time periods, discarding the first 200 to avoid the initial condition, some initial condition issues. So we end up with 100 years. Let's say if one time period is 1 quarter, we have 400 time periods, 100 years. Okay, so this is the baseline result. The model generates some endogenous growth and cycles, right? This is the log of the GDP, investment, consumption. Of course, investment is more volatile than GDP. This is the cyclical component of the filtered series. So we have endogenous business cycles in the model. Okay, the average capacity utilization is around 90. The dark gray band is the confidence interval, okay, for the 50 simulations. Okay, the line is the average across simulations. We have positive inflation. It seems to be growing, but eventually it stabilizes around 2% annually. This is some of the average aggregated variables. This is a work in progress. Now I'm just analyzing the aggregated results, but of course we can analyze the micro level. We can analyze each specific firm. We can analyze the effect, for instance, of monetary policy on each specific sector. But since this is still a work in progress, I'm first analyzing the aggregate results. So, for instance, we can calculate the profit share, the wage share, right? Profit here, profit share is the sum of industrial and financial profits. But if you look at the three distributions of each income class, we see here. So this is financial profits, this is industrial profits, and wages, right? Okay. Oh, yes, this is the average, but the model actually has a income distribution dynamics. In fact, the wage share decreases, which is not the Caldorian stylized fact, but is consistent with more recent empirical evidence, right? So in time, the wage share decreases and the profit share increases, right? This is the three classes. Apparently, the change is much more on the industrial side, not on the financial side, because we can see here the effective markup, the exposed markup of the industrial firms is increasing, their profit rate is also increasing. But we will do some experiments on the interest rate, and perhaps this will change when we change the interest rate. So let's do some initial experiments, okay? First, the baseline, we use 0.3 quarterly interest rate, so around 1.2 annual nominal interest rate, okay? And then we increase to 0.5, to 0.7, 0.9, okay? And we can compare with the baseline scenario. So here we plot the ratios. So if we look, this is the value in this setting compared to the baseline, right? So for instance, if you see 1.01 here is 1% higher than the baseline scenario. Easy to compare, and it's easy to run some simple t-test, right? So we can even test if the ratio is significantly equal to 0 or not, okay? So we can see that when we change the basic interest rate, what is my time? Okay. We have the profit share increase, but not too much. Yes, we have a gain in the financial capitalists. They gain more income share, okay? And this is very related to the capacity of the firms in, okay. The industrial firms, their capacity to pass their financial costs to prices. And this is exactly what we do next. Let's change their sensitivity, the sensitivity, the ability of the firms to pass financial cost prices. So let's say set it to 0. The baseline was 0.5. So basically, half of the financial costs will be passed. 5, let's set it to 0. So let's say firms do not incorporate financial costs in the price setting. What will happen when we change the basic interest rate in this sort of scenario? You can see here that in fact, the profit share and the wage share doesn't change, because this affects what we call the intra-capitalist distribution. In fact, if firms do not incorporate financial costs to their price setting, right? When we have an increase in the basic interest rate, we will have financial gains. The financial capitalists, of course, will receive more income, but this will squeeze the profit share, right? And we can even see not profit share, the profit rate of the industrial firms, right? It doesn't change too much, the wage share. So basically, who is losing here is class B, the industrial capitalists, right? If they don't have, they have they do not pass financial costs to prices. So let's change this parameter to 1. Let's see what happens when they pass the entirety of the financial costs to prices. And in fact, here we have, again, the financial capitalists, they gain a lot of income when we change the interest rate, but the industrial capitalists, they kind of remain the same. You can see that the profit rate doesn't change. So they basically have the capacity to adequate their prices to their financial costs, right? And this is the situation when workers lose more, right? So we have this pressure coming from the financial capitalists, but the industrial capitalists, they increase their prices to not lose profit margin. And in the end, who is losing is the workers here, who is losing more, okay? We do some experiments with the workers' bargaining power, so the parameters on the wage rate equation, right? So let's say if now the parameters were 0.5, let's change them to 0.9. So let's say the workers now have more bargaining power, they can have higher wages when they face higher past inflation and productive growth. But still, let's change the interest rate and see the effect. So yeah, we can see, so the financial cost is still relevant. So here it is 0.5. So we have a big increase on the 25% increase of the financial capitalists, basically because we have a high increase on the debt rate of the income classes in overall. Because of the wage price spiral, this will increase prices. This will affect their capacity to consume. They will demand more loans. This will increase even more the share of loans, the amount of loans, and of course the income the financial capitalists receive on their loans. Okay, so I run the same setting but changing the financial cost, but I'll skip to the conclusion so we have more time to discuss. So basically, to conclude, again, this is preliminary results, some simple experiments. We should look now at the sectoral level, at the micro level, but we can find some interesting results when we just relax the last link on the transmission channels. Let's just say that firms actually operate in oligopolistic markets, and let's say they face financial constraints and costs. What happens when we are in this kind of setting, more realistic setting? In this case, when we consider non-conventional channels, the heterodox channels we discussed, all the heterodox transmission channels we discussed are present in the model. We could see on the equations. And in fact, monetary policy fails. We didn't show, but in fact, inflation in all circumstances, in all experiments, inflation rises when the basic interest rate is increased. So in all cases, when we consider this setting, we face the Gibson's paradox, right? The price puzzle effect. We can capture the distributional effects of monetary policy. In fact, when we have higher interest rate, this will increase the debt burden, right? So the interest payment on the government bonds, this will affect the income of those who hold these bonds, which are usually the banks, financial institutions, or wealthy individuals, right? This will move the entire interest rate structure, but so both firms and households, they face the interest rate structure, but the essential difference is that firms eventually have the ability to increase their income. If they pass the financial costs to prices, they have this ability, while the households, we don't have our ability to, even if we have higher bargaining power, we cannot decide our income, right? So that's the main difference between the two classes. And again, this affects more specifically, the intra-capitalist distribution. Yeah, this determinant to capture this intra-capitalist distribution. As I just said, yeah, we found some interesting effect on the last simulation. Actually, I was running this a few days ago. I didn't have enough time to investigate deeper, but even it's interesting. So this is the setting when we have high workers bargaining power and firms have high ability to pass financial costs to prices. In fact, this is the setting where I calculated a simple Gini index on the three classes, not the best index we know to capture inequality, but it's simple to calculate for three. I just assume a share of the population for each class, and it was simple to calculate the Gini index. And in fact, this is the setting. That's actually an interesting point that for discussion. This is the setting when workers have higher bargaining power. This is the setting where increases in the interest rate actually increases inequality even more, right? So if we measure the sensitivity here of the Gini index, for instance, as one measure of inequality to the changes in interest rate, this is the setting where we can see here more than 80% increase on the average inequality. So yeah, this is something to investigate a little bit deeper, because we have the pressure from the financial cost to firms, but we also have this pressure from the workers, right? So I think this will increase even more on the final effect. Yeah, that's the conclusion. The final effect of the monetary policy, the interest rate on the distribution will fundamentally depend on the power structure, right? The power of the firms to set prices, the power of the households to bargain wages, and the power of banks to set their interest rates too. This is one thing I did not discuss here, but you could see in the equation that the interest equation there, the power of the banks to set that interest rate. This is fundamentally this power structure is what determines the final effect of the interest rate on distribution. That's some insights I could gain. Again, this is preliminary work. We can, for instance, we change the parameters that represent the power structure. One thing we can do next now is to endogenize those parameters. Instead of just changing their levels, we can try to endogenize and see what happens when they change dynamically within the simulation. So yeah, we have a lot more to do. Thank you.